Hello, everyone. My name is Irina. I am an enrolled agent with 8 years of tax experience. Today, I want to discuss the new proposals by Donald Trump's administration regarding taxation. Trump called the bill the One Big Beautiful Tax Bill. This is the government's website dedicated to the proposal. Let's examine it and analyze. It has the map of the United States of America showing how different parts may benefit from the proposals. It shows potential family savings with the child tax credit, with the itemized deductions, standard deductions, and small businesses claims. It also offers to download a one-pager. It's interesting statistics, but the calculations definitely are not straightforward and depend on many different factors, especially when we speak about California and the Silicon Valley, where I live. The average wages here are pretty high, and there are many restrictions for the additional costs, which we'll discuss later. So this is like a summary of what they are proposing, and you can see pretty bright column headers and titles. In particular, tax cuts for hourly overtime workers, tipped employees, tax relief for seniors. Yes, they are all present in the draft version of the tax bill, but they are not for everyone. In particular, to get an additional $4,000 deduction for senior, the GI must be below $75,000. Both tipped workers and overtime workers can't be what's called highly compensated employees. In 2020, mid limit was $155,000 per person for families with 2 children. This $5,000 refers to the potential increase in the child tax credit. Currently, it is $2,000 per child. The proposal includes $2,500 per child, but the same phase-out thresholds apply as they were previously. So if parents' joint income exceeds $400,000, then a phase-out starts and the child tax credit will be reduced or eliminated by $450,000 in joint ventures. After the summary, we have more detailed discussions of 3 parts of the tax bill. The first part is called Make American Families and Workers Thrive Again. And here they discuss the increase in the child tax credit and the elimination of tax on tips and overtime. They also propose a new deduction for the personal car loan interest, but again, there will be a threshold of $100,000 in GI for you to benefit from this extra deduction. What else? The relief for seniors. The next section is called Make Rural America and Main Street Grow Again. What is interesting and important in this section is that they propose to eliminate the reduced thresholds for issuing Forms 10. As you probably know, the current law requires that the threshold is decreased, and so from year 2027, all third-party networks like PayPal, Venmo must issue 1099 forms for everyone who receives more than $600 per year through those platforms. So the new tax bill proposed to eliminate that and to increase the threshold for 1099 reporting from $600 to $2,000, and also remove the requirement for third-party networks to issue forms unless there are more than 200 transactions completed for a particular person via those platforms. The next section is called Make America Win Again, and it discusses some additional taxes for universities and private schools, and it also eliminates Medicare and Medicaid benefits for illegal immigrants. Neither of these sections mention that certain currently present tax credits are proposed to be eliminated, but I've read the summary version of the tax bill, There are two important credits which are set to expire by the end of 2025. In particular, all clean vehicle credits. The rules come back to pre-2023 when there were strict limits on the sales volumes by big manufacturers. Any manufacturer which has already sold more than 200,000 vehicles is not eligible for a clean vehicle credit. Tesla will stop being eligible again. And the current rules are valid until the year end 2025. Another important credit is the solar panel credit or the residential energy credit. These are credits for those who install solar panels or any other alternative energy generating source in their residential homes. The current credit is 30% of the installation costs. This is also set to expire by the end of 2025. It's important to emphasize that the current bill is set to be approved through the reconciliation process, and this process restricts any increase in the budget deficit over a 10-year span. Many of the provisions from the 2017 tax reform have been continued, but for only 3 years, for 2025 until 2028. This is directly related to this 10-year span. After that period, they will need to reconsider them again, and so they are not being proposed as permanent as of now. It's very important that they discuss the SALT limitation. This is the restriction of $10,000 in the deduction for local taxes, which currently considerably limits itemized deduction in those areas where the local taxes are high, in particular California or New York. So this SALT limitation is proposed to increase to $30,000 versus $10,000 currently. But again, there will be a phase-out limit. So if your joint income exceeds $400,000, then the increased SALT limitation will be gradually phased out to $10,000 as it is now. Currently, this provision is heavily debated. States like California or New York are proposing to increase it to $80,000 instead of $10,000. But again, it is all subject to limitation of the budget deficit. Let's see how it will proceed and whether they will be able to push it through. Because it's very important for states with expensive real estate. The proposed changes are definitely positive for those who are in the middle class tax brackets and own their primary residence. Subscribe to my channel and keep watching new videos regarding this topic. I'll try to be prompt. Thank you very much for your attention.